In December 2008, a 70-year-old man walked into FBI headquarters in New York City and confessed to running the largest financial fraud in American history. For 2 decades, he had promised guaranteed returns to thousands of investors. For 2 decades, he had delivered exactly what he promised, month after month, year after year. His clients received their statements, showing steady, consistent profits. No volatility, no losses. Australiable, predictable gains, and every single dollar of it was a lie. But here's what should keep you up at night. The real mystery isn't how he did it. That part is almost embarrassingly simple. The mystery is why thousands of sophisticated investors, financial professionals, and even regulatory agencies couldn't see what was happening right in front of them. Why did people who should have known better keep investing? And more importantly, why are you still seeing the exact same promises today? By the end of this video, you'll understand why the words guaranteed returns should trigger the same alarm bells as free money or risk-free profits. But first, we need to understand how we got here. The promise of guaranteed returns isn't new. It's as old as money itself. But to understand why these schemes keep working, we need to go back to a moment in American history when this promise seemed not just believable, but reasonable. The year was 1919. World War I had just ended. Americans were eager to rebuild, to invest, to believe in a prosperous future. The stock market was booming, and everyone wanted in. But most people didn't understand how markets worked. They just knew that some people were getting rich, and they wanted their piece. Enter Charles Ponzi, an Italian immigrant living in Boston with big dreams and very little capital. Ponzi discovered an opportunity in international postal reply coupons, a system that allowed someone in one country to pay for postage in another. Due to exchange rate fluctuations after the war, these coupons could theoretically be bought cheap in one country and redeemed for profit in another. Ponzi promised investors a 50% return in 45 days, or 100% return in 90 days. Guaranteed. And here's where it gets interesting. Ponzi actually paid out these returns. Early investors received exactly what they were promised. Word spread. Money poured in. Within months, Ponzi was taking in millions of dollars. He bought a mansion. He became a celebrity. He was living proof that the American dream was real. But Ponzi had a problem. Actually, he had the problem. The postal coupon scheme never worked at scale. It was impossible to actually buy and redeem enough coupons to generate the returns he was promising. So, where was the money coming from? That question wouldn't be answered until it was too late, and the answer would give birth to a type of fraud that still operates today, nearly unchanged in its fundamental mechanics. Here's what Ponzi figured out, and what every guaranteed return scheme since has replicated. You don't need a real investment strategy if new money keeps coming in. The mechanics are almost insultingly simple. Investor A gives you $10,000, expecting a guaranteed 10% return. You promise them $11,000 in 1 year. You don't invest their money. Just wait. When Investor B gives you $10,000 a few months later, you use $1,000 of their money to pay the profit to Investor A. Investor A is thrilled. They tell their friends, "Tay, Rainbess, more people come in." As long as new investments exceed old obligations, the scheme works perfectly. You're not running a business. You're running a mathematical timing game. The money isn't growing. It's just moving. But the statements you send investors show growth. The checks you write them are real. And because human psychology craves certainty in an uncertain world, people believe. Ponzi's scheme collapsed in August 1920. Less than a year after it started, newspapers began investigating. A financial journalist asked a simple question. If Ponzi was really making these kinds of returns through postal coupons, why weren't there massive movements in the postal coupon market? Where were the transactions? The answer was nowhere. They didn't exist. Ponzi's company collapsed within days once the truth came out. Investors lost approximately $20 million, equivalent to roughly $300 million today. Ponzi went to prison. The scheme became so infamous that it earned his name. But here's what most people miss about this story. Ponzi's scheme worked because of trust, not complexity. His investors weren't stupid. They were hopeful. They wanted to believe that someone had figured out a system, found on age, discovered a way to beat the uncertainty of normal investing. And once the first returns came through, confirmation bias did the rest. The question is, If this scam was exposed over a century ago, why does it keep working? Fast forward to 1960. A young stockbroker named Bernard Madoff starts his own investment firm in New York. Unlike Ponzi, Madoff isn't a nobody with a dream. He's legitimate. He serves on boards. He helps create NASDAQ. He becomes chairman of the NASDAQ Stock Exchange. When he tells you he has a sophisticated investment strategy, you believe him. Because why wouldn't you? But Madoff had learned something from studying market history, including schemes like Ponzi's. He learned that the problem with promising 50% or 100% returns is that they're too good to be true. They attract attention, they invite scrutiny. So Madoff did something brilliant. He promised modus, consistent returns. 10 to 12% annually. Nothing spectacular, nothing that would raise red flags. And this is where it gets genuinely disturbing. Madoff's scheme ran for approximately 20 years before anyone seriously challenged it. 20 years, through market booms and crashes, recessions and recoveries. Madoff's returns stayed remarkably consistent. When the market dropped 30%, his clients saw returns of 10%. When the market soared 40%, his clients saw returns of 11%. Month after month, year after year, the statements showed steady profits. His clients included celebrities, executives, charities, pension funds, and sophisticated financial institutions. These weren't unsophisticated investors. These were people who should have known better. Some of them did know better. They suspected, but they didn't want to believe they were wrong, so they stayed in. Meanwhile, similar schemes were operating worldwide. In Albania in the 1990s, pyramid schemes collapsed and nearly destroyed the country's economy. In Romania, a scheme called Caritas claimed to be using highly sophisticated computer algorithms to generate guaranteed returns. It was just the same old trick with new language, the Como thread. All of these schemes relied on the same psychological principles. They promised certainty in an uncertain world. They used the credibility of early successes to override skepticism. They created exclusive clubs where being part of the scheme signaled intelligence and access. And they all ended the same way. But what actually triggers the collapse? Why do these schemes break? Because if new money keeps coming in forever, theoretically they could run indefinitely. Every Ponzi scheme faces the same mathematical inevitability. Exponential obligations meet linear growth. Or to put it simply, you eventually owe more money than is physically coming in the door. Here's why. Let's say you start with 10 investors giving you $10,000 each. That's $100,000. You promise 10% returns annually. At the end of year one, you owe $110,000 in value. But you only have the original $100,000 plus whatever new money came in. To pay those returns, you need at least 10 new investors at $10,000 each. Year two, you now have 20 investors who all expect 10% returns. You need even more new investors. Year three, more still. The scheme requires constant exponential growth of new money just to maintain the illusion. Eventually, the math breaks. You can't find enough new investors, or something external happens that causes withdrawals to spike. For Madoff, the breaking point was the 2008 financial crisis. Markets were crashing. People were panicking. Investors who had never planned to withdraw their money suddenly needed cash. Redemption requests flooded in, and Madoff couldn't meet them because the money wasn't there. It had never been there. In December 2008, Madoff told his sons the truth. They contacted authorities. The scheme collapsed. The scope was staggering. $65 billion in claimed account value, approximately $18 billion in actual investor losses. Thousands of victims, charities wiped out, retirement funds destroyed, lives ruined. But here's the truly disturbing part. Multiple people had tried to expose Madoff years earlier. Financial analyst Harry Markopoulos had submitted detailed evidence to the SEC in 2000, showing mathematically that Madoff's returns were impossible. He presented his findings again in 2001, 2005, and 2007. Each time, regulators failed to act. The SEC investigated Madoff multiple times and found nothing wrong. Why? Because Madoff was respected. He was connected. His clients were wealthy and influential, and the people investigating him didn't want to believe that someone so prominent could be running such a simple scam. They looked for complexity where there was only fraud. They assumed sophistication where there was only theft. The collapse sent shockwaves through the financial world. Surely, people thought, this would be the end of guaranteed return schemes. Surely, no one would fall for this again. They were wrong. Madoff was sentenced to 150 years in prison. He died in 2021, still incarcerated, but his scheme's impact extended far beyond his personal fate. The immediate aftermath saw panic and reform. The SEC faced intense criticism for missing obvious red flags. New regulations were proposed, enhanced auditing requirements, stricter oversight, more funding for enforcement. The message was clear. This could never happen again, but reform faced a fundamental problem. You can't regulate away human psychology, and you can't create enough regulators to monitor every investment opportunity. In 2009, just months after Madoff's arrest, prosecutors uncovered another Ponzi scheme run by Alan Stanford. His scheme had defrauded investors of $7 billion. It had been operating since the 1980s, throughout the 2010s. Cryptocurrency and blockchain technology created a new frontier for guaranteed return promises. Schemes like BitConnect promised consistent daily returns through trading bots and volatility software. OneCoin claimed to be the next Bitcoin while operating a classic pyramid structure. These schemes collectively stole billions from investors worldwide. The pattern repeated with depressing consistency. New technology, new terminology. Same old fraud, but the promised returns always followed the same formula. Too consistent to be real, modest enough to seem plausible, and backed by explanations complicated enough to discourage questions. Regulators played whack-a-mole. They'd shut down one scheme, and 3 more would pop up. They'd prosecute one fraudster, and others would learn from the mistakes. The fundamental vulnerability remained. People's desire for certainty and consistent returns in an inherently uncertain world. But the story doesn't end with regulation and prosecution, because right now, today, as you're watching this video, these schemes are still operating. They've just evolved. There are mathematically impossible returns being promised that continue to attract new investors. Let me show you something that should concern you. In 2023, cryptocurrency lending platforms promised annual returns of 8 to 12% with no risk. They claimed to generate these returns through lending to institutional investors and trading strategies. Several of these platforms collapsed in 2022 and 2023, revealing they were operating on Ponzi-like structures. Celsius Network alone had over $20 billion in liabilities when it filed for bankruptcy. But crypto isn't the only place these schemes hide. They've infiltrated forex trading groups, promising consistent monthly returns. They're in real estate investment clubs that guarantee fixed returns regardless of property performance. They appear as AI trading algorithms that somehow beat market volatility. They exist in agricultural investments promising guaranteed crop yields. They're everywhere. The modern versions have learned from history. They're more sophisticated in presentation. They use blockchain terminology. They show you complex dashboards. They have professional websites and registered businesses. They might even have actual operations that generate some revenue. But underneath, the mathematics remain the same. They're paying old investors with new investor money. Here's the data that should alarm you. According to FBI reporting, Americans lost over $3.3 billion to investment fraud in 2022 alone. That number only represents reported cases. Many victims never report because they re-embarrassed or do want to realize they've been defrauded until it is too late. The median loss per victim was $70,000. Think about that. These aren't small amounts. These are retirement funds, college savings, life savings, and the victims aren't just elderly people, as stereotypes might suggest. Fraud victims span all age groups, income levels, and education backgrounds. In fact, some research suggests that people with financial education are sometimes more vulnerable because they are confident in their ability to evaluate opportunities. The schemes also adapt to cultural contexts. In some communities, they operate through religious organizations, exploiting trust networks. In others, they target professional groups like doctors or lawyers, who assume their intelligence in one field translates to investment acumen. Some specifically target immigrant communities, promising better returns than traditional American banks while exploiting language barriers and unfamiliarity with financial regulations. Social media has turbocharged the problem. Schemes spread through Instagram influencers showing luxury lifestyles, through WhatsApp groups sharing exclusive opportunities, through YouTube channels explaining passive income strategies, through TikTok videos promising financial freedom. The distribution is decentralized, making it harder to shut down, but the core fraud remains centralized in the same old structure. And here's the most disturbing parallel. Just like with Madoff, there are whistleblowers right now trying to expose schemes that regulators haven't stopped yet. There are mathematically impossible returns being promised that continue to attract new investors. There are people today writing checks with money they don't have, knowing that tomorrow's deposits will cover them, until they won't. So why does this keep working? If the scam is so old and so well known, why do people still fall for it? The answer lies in understanding several psychological principles that fraudsters exploit ruthlessly. First, there's the desire for certainty. Real investing is uncertain. Markets fluctuate, returns vary. Some years you make money, some years you lose money. But humans hate uncertainty. We're wired to prefer a guaranteed small gain over a probabilistic large gain. When someone promises guaranteed returns, they're offering psychological comfort more than financial returns. And we'll pay for that comfort. Second, there's social proof. When you see others investing and receiving returns, you assume the opportunity is legitimate. This is especially powerful when the other investors are people you respect or aspire to be like. If your successful neighbor is investing, if your wealthy friend is involved, if respected community members are participating, the scheme gains credibility through association. You don't want to be left out. You don't want to be the one who missed the opportunity. Third, there's the complexity shield. Fraudsters deliberately make their strategies sound complicated. They use technical jargon, sophisticated sounding algorithms, and proprietary methods. This serves two purposes. It makes you feel like you do you and understand it well enough to question it. And it makes you feel smart for being included in something so advanced. If you can't understand how it works, you're less likely to spot the impossibility. Fourth, there's confirmation bias. Once you've invested, you want to believe it's legitimate. Every statement showing returns reinforces your decision. You ignore warning signs because acknowledging them means admitting you made a mistake. You might even defend the investment against skeptics because you've taught your ego to being right. Fifth, there's the sunk cost fallacy. The longer you're invested, the harder it is to pull out. You've already committed money. You've already received some returns. Leaving now means accepting that those returns were fake. So, you stay in. You might even invest more, trying to maximize your gains before pulling out, which is exactly what the scheme needs to continue. And finally, there's the authority bias. When the person running the scheme has credentials, reputation, or social status, we're less likely to question them. Madoff was the chairman of NASDAQ. How could he be running a fraud? This doctor has investment certificates. This pastor has been serving the community for years. This influencer has millions of followers. We confuse credibility in one domain with credibility in investing. Understanding these psychological vulnerabilities doesn't make you immune to them. It just makes you aware. And awareness is your first line of defense. Let me give you 3 concrete takeaways that could save you from becoming a victim. Takeaway number 1. Guaranteed returns don't exist in legitimate investing. This is the fundamental truth you need to internalize. Any investment that claims to offer guaranteed returns with no risk is either lying or omitting critical information. Real investments have real risks. The potential for gain always comes with the potential for loss. If someone promises you consistent, guaranteed returns, regardless of market conditions, they're either running a Ponzi scheme or they're offering you a savings account with a bank, and bank savings rates are nowhere near the returns these schemes promise. When someone says guaranteed, ask them what mechanism guarantees it. Is it government-backed insurance like FDIC? Is it a contractual obligation backed by specific assets? Or is it just their word? If it's just their word, it's not actually guaranteed. It's just a promise, and promises break. Takeaway number 2. Complexity is often a red flag, not a selling point. Legitimate investment strategies can be explained in simple terms. Yes, the execution might be complex, but the basic principle should make sense. If someone can't explain how returns are generated in a way you understand, that's a warning sign. Proprietary algorithms, advanced trading strategies, exclusive market access. These phrases often hide the absence of a real strategy. Warren Buffett, one of the most successful investors in history, has a rule: never invest in something you don't understand. If you can't explain how the investment makes money, don't put your money in it. This doesn't mean you need to understand every technical detail, but you should understand the basic economic engine. Real estate makes money through rent and appreciation. Stocks make money through company profits and growth. Bonds make money through interest payments. If you can't identify the actual source of returns, walk away. Takeaway number 3, past performance doesn't guarantee future results, but consistency, despite market conditions, is impossible. This is subtle but crucial. Legitimate investments have volatility. They go up and down with market conditions, economic cycles, and business performance. When you see statements showing month after month, year after year of consistent positive returns with no significant variation, you should be skeptical. That's not how real markets work. Madoff's returns were too consistent. That was the tell. Real traders have bad months. Real funds have down years. Real investments reflect real market conditions. If someone is showing you perfect consistency, they either showing you fake numbers or they in extraordinarily safe investments that could unpossibly generate the returns they're reclaiming. Here's what keeps me up at night about this whole topic. Right now, someone is watching this video while they're invested in a Ponzi scheme. They're thinking, well, that's interesting, but my investment is different. My fund manager is legitimate. My returns are real. Maybe you're right. I genuinely hope you are. But I want you to ask yourself something. If I am right, what evidence would I need to see before I believed it? What would it take for you to recognize the warning signs? Because the victims of every collapsed scheme thought theirs was different too. They all had reasons to believe. They all had explanations for why the skeptics were wrong. The truth is, you can't eliminate all risk from investing. You can't guarantee consistent returns. You can't find a secret strategy that beats market reality forever. What you can do is accept uncertainty, diversify your investments, work with regulated professionals, verify everything, and run like hell when someone promises you guaranteed returns. The con artists are counting on your hope, your trust, your desire for financial security. They're betting that you'll let those emotions override your critical thinking. Don't let them win that bet. And here's the uncomfortable question I want to leave you with. How many legitimate opportunities have you missed because you were too skeptical? Versus how many fraudulent schemes have you avoided by being skeptical? I'd argue that missing out on a legitimate investment costs you potential gains, but falling for a fraudulent scheme costs you actual money. The math favors skepticism. The promise of guaranteed returns is the financial equivalent of a perpetual motion machine. It sounds amazing. It would be revolutionary if it existed, but it violates the fundamental laws of how markets work. Just like you can't create energy from nothing, you can't create consistent returns without corresponding risk. Every major Ponzi scheme collapse is followed by the same statement from regulators and experts. We need to do better. We need stronger regulations. This can't happen again. And then it happens again. Because the vulnerability isn't in the regulatory system. It's in human nature. We want to believe. We want certainty. We want to feel smart and included and successful. The fraudsters know this. They're counting on it, and they're very, very good at exploiting it. So here's what I want you to do. Share this video with someone you care about. Not because you think they're currently being scammed, but because knowledge is the best defense. Talk about it at dinner. Discuss it with friends. Make financial skepticism normal and acceptable rather than embarrassing or cynical. And if you're currently invested in something that promises guaranteed returns, I want you to do something difficult. I want you to seriously investigate it with the assumption that it might be fraudulent. Not hoping it's legitimate, assuming it's not. Look for the actual source of returns. Verify the audits. Check if the firm is properly registered. Talk to an independent financial advisor who has no connection to the investment. You might discover it's legitimate, in which case you've just gained peace of mind, or you might discover warning signs you've been ignoring. Either way, you'll know the truth. The con artists are betting you won't do that work. They're betting you'll trust and hope and wait until it's too late. Prove them wrong. If you found this valuable, hit the like button and subscribe for more deep dives into financial reality. Drop a comment below how we or someone you know encountered a guaranteed return scheme. What up in it? Thanks for watching. Stay skeptical, stay informed, and remember, if it sounds too good to be true, it definitely is.